Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. It's a big week for some of Australia's largest and most widely held companies. Reporting season really kicks in this week. It's headlined by household names like Commonwealth Bank and Telstra. Anna Milne is a senior investment analyst at WAM Leaders, a listed investment company from Wilson Asset Management. Anna, welcome to Fear and Greed.
Thanks for having me, Sean.
Before we get into these big companies, the overall, what are you looking for this earnings season? What's sort of the kind of big thematics you expect to see?
Often what's more important than the earnings themselves is the outlook statement. So we're really focused on the outlooks of these companies into FY25. Result season is ultimately the rear vision, which doesn't matter when it comes to markets. And so it's really about how the next 12 months is going to deviate from where the market is sitting.
Okay, so let's jump into it. Commonwealth Bank, biggest company on the ASX. What are you expecting from the country's biggest bank?
So fundamentals have really taken a back seat to positioning and market flows when it comes to the banks and mostly to CBA. It's up at least 20% year to date and really just has been unstoppable. But the result day will really be focused on fundamentals. And I would say that they are fine. I would say that NIMs or net interest margins are broadly stable now, though we are hearing more recently that competition has picked up again. CBA being one of the culprits, it does sound like they have stepped into the market slightly more aggressively. So we expect the earnings should be okay. Potentially, they might see higher credit growth but slightly lower margins as a result of the increased competition. But overall, really, it does come back to the positioning and the flow in the Australian banks.
Is there a risk, particularly with Commonwealth Bank, that it's priced to perfection, the idea that it's trading at very high levels on a historical basis? And there are reasons for that, no doubt. But is there a risk that if it does disappoint just a touch, it could be sold off quickly?
Definitely. And I think particularly on result day, that is when that conversation comes to the fore. But what we've really seen from CBA is blanket buying. So whether it be offshore capital wanting to buy in Australia instead of China, for example, they actually don't really care about the Commonwealth Bank and any of the other banks' fundamentals. They simply want exposure to the Australian market. So that has been the overriding dynamic more than fundamentals necessarily. But certainly when they produce a result that is at best okay, and you look at where it's trading, it's very hard for fundamental investors to really want to enter a sizable position at current levels.
Yeah, I just think Commonwealth Bank will be one of the most interesting results of the season, which normally it's not, just simply because it has run so hard. What about Telstra? That's owned by more retail shareholders than any other company in Australia.
Telstra, we expect, will actually be a very good reporter. So they have already cleared the decks at the end of May with the announcement of their change in pricing, as well as a cost-out program. And since then, they have actually raised mobile pricing faster than expected. Our understanding is that they were waiting for Optus to increase their prices. So as soon as Optus increased, Telstra followed not long after. And that has really happened sooner than the market was anticipating. So for that reason, we think there's a possibility that they beat from an earnings perspective, because mobile really is the vast majority of earnings for Telstra. The more contentious area of the business is probably the enterprise division. It's currently undergoing a strategic review because it has been affected by both cyclical and structural headwinds. But this is really being reset now and should hopefully grow over the coming years. Management has been cautioning that this is a multi-year turnaround story, so not to have any expectations, but that will be certainly an area that we'll be watching at the result. When focused on the medium term for Telstra, I would say it's more important to think about the Investor Day later in the year, because that is when we expect they could reveal their T30, so their FY30 or 2030 targets.
Stay with me, Anna. We'll be back in a minute. I'm speaking to Anna Milne from Wilson Asset Management. So how hard is it for a company like Telstra to compete in the modern world? I get that mobile is where they're doing well and they're upping prices. I know that from personal experience. But what about the rest, the enterprise, the media area? It must be very difficult because they're competing with big tech.
They are, and that has been the exact problem, is that the offering that they have been providing simply isn't used anymore. Even when you think about your work phone, how often do you pick up the desktop phone now versus using your mobile or sitting on a Zoom call or a Teams call. The use case is certainly less relevant than it was a few years ago, and that comes to the structural headwinds that they are facing. On the cyclical side as well, businesses are in a tough spot at the moment, and so they're not really wanting to upgrade their IT software if they don't have to, if their profitability is challenged. So that is definitely the headwinds that Telstra is facing, but it is more than overshadowed by the mobile business. I think if we think about the tailwinds to mobile, we all use our phones so much more than we did even 5-10 years ago, and the prices just haven't really kept up in line with, I guess, the value we get from our mobile phones. So I think they could, although it's tough on consumers, they could double prices and everyone is still going to use a mobile phone, and the whole market is actually under earning. So when we think about industry returns, we have Optus increasing prices, we have TPG Vodafone increasing prices, and Telstra. So at some point, returns should hopefully restore and there might be more equilibrium in the market. But until then, we think mobile prices will keep going higher.
And I pay for 3 of my kids' mobile phones on Telstra. That was really, really bad 30 seconds for me. Let's move on. Goodman Group, property leader, industrial giant. It's beyond property though, Goodman, in a sense. It's benefiting from AI and all sorts of other things as well.
It certainly is, and Goodman's results are reliably solid. And even if they are a little bit weak, the market has so much love for Goodman that there's a degree of conservatism that's assumed, and everyone thinks that they're just going to underpromise and over-deliver. So it's often hard to go into a Goodman result with a negative view because they can really just prove you wrong quite easily. But interestingly, recent read-throughs for the industrial market have been a bit soft, even in those key catchment areas in South Sydney, for example. So it's quite interesting to see that industrial market turn. But on the flip side, we have the data centre strategy, and that is really coming to the fore. So I think that will disguise any weakness in their underlying business as that data center strategy just continues to gather momentum.
Okay, so they're 3 of the top 10 stocks, CBA, Telstra and Goodman. Let's go to kind of some of the, they're still large companies, just not quite as large. AGL Energy. I always find it hard to get my head around this company and what its prospects are, because it's sort of in an industry going through so much turmoil, and there's been all sorts of M&A activity in that industry for the last couple of years. Where's that one up to?
It's definitely a tougher stock to keep on top of, but the setup for 25 looks very good in our view. We're 1 month in, so caution that it's just July that we're talking to, but the cold weather has really spiked electricity demand and electricity prices, and so that is materially increasing the current revenue and earnings for AGL, but it should also help forward pricing over the next few months. So it's something we're watching quite closely, but will no doubt probably give a slightly more positive tone at the result next week.
Okay, Cochlear, the hearing implant group.
Cochlear is such a great business. Revenues consistently grow at 10 to 15%. You're earning 75% gross margins, 18% profit margins. And to top it all off, they're doing an incredible thing for the world. So the only part about Cochlear that is challenging from an investment proposition is its valuation. And there's no real way around that. It's an expensive company and expectations are high. So if they don't deliver between 10 and 15% revenue growth, I would expect the stock would get hit. But I think the setup is still quite strong. It looks like operationally they're executing. They have a lot of tailwinds at a sector level, and I don't see any real reason for a significant sell-off, given the other prospects in the healthcare sector all are quite problematic, whether it be from a valuation perspective or an earnings uncertainty perspective. So Cochlear does feel like the stock to own in healthcare in our view at the moment.
What is it about? Is it just that their competitors aren't as good as Cochlear? Because I totally get what you're saying. Cochlear has gone from strength to strength for years, probably decades now. It's probably that old. Is it just that there's no competitors? I mean, there are competitors, but are they just not good enough? I never quite understand why Cochlear just keeps on keeping on.
Yeah, you're right. I mean, they are such a large part of the market. You can almost call them the market now. And there has been some competitor recalls in recent years. And Cochlear hasn't been completely devoid of them themselves. I think around a decade ago, they had a recall themselves. But certainly their market share is so strong. I think it's around 70 to 80% now. That they really are the market, and they are driving penetration for the whole market And that really is the next driver of growth for Cochlear, is the adult segment. So they're quite well penetrated when it comes to the pediatrics, so children. But the adults is really just beginning to hit the road, I would say. And we're really starting to see some of their marketing initiatives pay off when it comes to awareness of cochlear implants versus the likes of hearing aids and the association between hearing loss and cognitive decline. So that is a big push from Cochlear, and it's starting to pay off.
Finally, ASX Limited, the company. Now that has had a rocky road.
It has, yes. That's been rocky to say the least. But at the same time, I would say this result is probably low risk. So they had an investor day only 2 months ago. It was at the start of June, and they provided earnings guidance for the next year. And they also released these monthly activity reports. So we're broadly across all the trends. And what they've really disappointed on is actually just the cost side and the CapEx side, as they've tried various programs. But we're just not going to get an update on them at the next result. So in that way, it's low risk. And it will take longer, though, for them to prove that they can execute on the current programs. And so we think over the medium term, it will probably still trade at a discount, despite the fact it is, critical infrastructure, it's monopolistic, they can put through price increases. In the last couple of months, though, and certainly in the last week or so, the market volatility would have benefited them. So that's positive.
I always think with ASX, if it can just get its ship into order, ship shape, I'm not sure what the phrase is, but, if management can just kind of work it out, because it is more or less a monopoly, it's got pricing power, so much potential, if only.
Definitely. And that's why often the topic of M&A comes up for them as well. Are they a potential acquisition target from the likes of a super fund and the like? But certainly when we compare them to exchanges offshore, they're still really expensive and don't have the same growth profile. So if you're an international investor, there's not really much of an argument to make the ASX stack against the likes of the NASDAQ, which is trading on a far lower multiple and has a lot more growth optionality. So it's a very interesting one, but I do see your point.
Mm-hmm. Anna, thank you for talking to Fear and Greed.
Thanks, Sean.
That was Anna Milne, Senior Investment Analyst at WAM Leaders, a listed investment company from Wilson Asset Management. This is the Fear and Greed business interview. Remember, this is general information only, and you should always seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.